Okay, welcome everyone. So it's good to see everybody early on a Wednesday morning. I'm going to be talking about the compression breakout setup and strategy. This is a setup that typically is fairly different than what most people look for in the markets for predictive patterns, but it's an interesting one, and it's certainly one that is worth taking a look at and learning about. So let's go ahead and get started and jump right in. My background really is developing indicators and trading models for hedge funds for about 20 years, and I have been speakers at various events. I've published a book with John Wiley & Sons, and then also have been on the quant side of trading really for the better part of 25 years. So that's more or less my background. Let's just briefly touch on the risk disclaimer. Jeanette hit this a second ago, but trading involves a high level of risk and is therefore not suitable for all traders. Before deciding to trade, you should carefully consider your trading objectives, level of experience, and ability to tolerate risk. Excuse me. Okay. Now, also a hypothetical results disclaimer. Hypothetical or simulated performance results have certain limitations. Unlike actual performance record, simulated results do not represent actual trading. So just understand that. I'm going to show you a couple example trades and model both the compression setup. We'll define it, we'll model it, and I'll show you some ideas on how to trade it either with the underlying contract or with options as well. So there's a couple of ways to approach that. Now what I want to cover today, basically we'll be defining the compression setup. It's going to be, just a second here, I'm going to pull out my pen app. It's going to be talking about the compression market theory as well. And then I'm going to also touch on a long volatility compression option strategy as well, and then talking about trading compression breakouts. So I'm going to present a actual way that you can consider trading compression patterns using the traditional breakout strategy. Now, defining the compression setup, let's first go ahead and talk about that. Compression setups are periods when price volatility falls dramatically and trades within a narrow range. So you've got to be able to differentiate this, or we have to, between slow markets and periods of time where there's a fierce battle going on between buyers and sellers. And that's what we're looking for. So we're looking for a kind of a stalemate, a brief stalemate period where it's not caused obviously by a night session that's slow in Asia. It's caused by more or less a high pressure situation where buyers and sellers are facing off, and they're essentially about equal in strength until one of them breaks out and gets the better of the other one. So that's what we're looking for when we talk about compression strategies. There's a number of different indicators out there that can track them. I'm going to show you today one called the linear compression indicator, and that's what you see here on the chart. So if you take a look at, we'll look at the second one here in my chart, and that is represented by these two blue lines that are parallel and horizontal here, and it's around a period of time depending on how we define the compression, but this is mathematically defined. So sometimes you'll see the compression zigzagging around a little bit, and other times it's a little bit more well-defined within the range of the two horizontal lines. So that's what we're going to be looking at in terms of how we define compression here. Okay, excuse me. Compression market theory. Yeah, sorry, I'm struggling with allergies a bit this morning. Market technicians believe that price compression periods store energy when prices compress. So again, it's the idea of not a slow, the idea of evolving and then reaching a defined period of time where the buyers and sellers are essentially at stalemate. But it's not because the market's slow, it's just because the balance of power is fairly equal. Price compressions are an equal balance of power and battle between buyers and sellers, and that's what we're looking for. Now, tighter compression periods are often thought to store more explosive energy. So we can define that, and I'll show you how we can measure that. But coming from a large volatility environment down to a compression period, it's thought that this period actually stores energy, and then once the compression period's over with, then you see a big release of energy, and that's what we're hoping to trade. And that's what essentially gives us the edge that we're looking for when we identify compression patterns. So compression periods are typically considered to be more powerful when these periods last longer as well. And that's not always the case, but that's in general what we can look for with these types of patterns. So in this particular example right here, you see this is the Apple and NASDAQ market, and this is a 240-minute chart. So compression patterns can be across all time frames. You can see them on daily charts. You can see them on 240, 120. The 120 and 240 charts, believe it or not, on Apple are really oftentimes very good compression patterns. And you'll find that they work for certain markets better than others. So that's one thing to watch out for. Excuse me. So this is what it kind of looks like. You see a very strong run up here, and you can see some big price bars. So there's a lot of volatility in the market. And then all of a sudden you reach a sideways period of time here. And it can be, what I usually track is 5 bars at a minimum, but you can define more than that as your minimum to track it or to plot it on your chart. So this is a compression pattern lasting for 16 days, and I'll get into that here in just a minute. And then also there's a defined compression, if you will. The tightness of the compression is defined by average true range. And this is defined, and this particular one is 0.94. So it's less than the average volatility that you've been seeing over time. And I find that when you see a larger number than 1, you have to look at that more carefully as to whether that's an opportunity you want to go to pursue in terms of trading. So that you see those compression patterns show up, and I'll show you how they break out, and I'll show you how you can potentially trade those as well. So post-compression periods then release the energy in the up or down direction. Now this is the big unknown, is the direction of the market after the compression period. So this is a different type of analysis. Most of the time we're looking at technical analysis that is designed to forecast market direction. This is a setup where we're actually forecasting increase in volatility. And it can either be in the up direction or the down direction, and that's really what we don't know. But we can tip the scale a little bit by bringing other indicators into the mix, like cycle indicators and general momentum indicators and things like that. So there is a way to give ourselves a little bit of an edge there. But in general, these compression setups they're not designed to give a directional bias. They're designed to give a volatility bias. So we're interested in that release of energy and the increase of volatility after the compression. So you can see here by the first compression, last 16 bars, and then you get that energy release. That's what you're looking to trade as a trader. And once that's done, you're done. So you don't want to overstay your welcome. But there are some strategies you can actually consider if you're looking at a longer term trend, for example. So if you see a compression pattern in this example for Apple, and you think that there's a pretty good argument that there's a longer term opportunity for Apple, then what you want to do is what you can do is put a break-even stop in where you initially got into the profitable trade, capturing the release of energy, and then you can ride out the longer-term trend, for a higher duration. But when you're talking about specifically the edge that a compression pattern offers, it's for that energy release, and once that's done, then you're done. Then you essentially finish and you complete the pattern and look for the next compression setup. Now, compression setups store energy. That's the theory behind them. So when you see, again, a volatile period and then compressing down to a sideways period where there's a stalemate between buyers and sellers, that's the storage of energy. And then right after that, again, what we're looking to do is trade the release of energy. Okay, now, one of the things that can make this a little bit tricky sometimes is we don't always know the duration of a compression pattern. So you can see that the first pattern lasted for 16 bars. The second pattern lasted for 8 bars. So you've got to be a little careful. If you jump in prematurely or catch it too early on, you could be whipsawed either by taking false signals in the up direction or the down direction before the energy release happens. And so that's one of the risks here. That's one of the things we've got to consider. But sometimes it works out really nicely where you have the compression pattern and then it just takes off in one direction. And that's kind of what's happening here. The unknown is how long will the compression pattern last, and how long will the energy release last as well. So I'll show you from an energy release standpoint that you're basically looking at, you can look at a few different indicators to shed some light on that. So and we'll jump over to TradeStation here in just a minute and show some examples of actual markets here in recent days and how the volatility of those markets are, are play out in terms of the volatile markets leading into the compression patterns and how those look on both intraday and end of day charts as well. So one of the things you can do with this setup also is use a long volatility strategy, a long vol strategy using options. So large price moves, because large price moves oftentimes follow compression setups, you can use neutral option strategies to trade these setups. So one of those, or I'll show you actually two of those you can consider. So in this particular case, these examples with Google here, we're looking at, again, daily price bars, and then once the compression breaks out and you get that energy release, then in theory, you can use a neutral option strategy to take advantage of that. And again, I would emphasize that if and when, and there's an if there, it doesn't always happen where you're guaranteed to get that energy release, but if it does happen and it takes off in the upside or downside direction of the market, you need to carefully watch for the ending of that energy release. And that's when you're done trading your option strategy. So there is a timing element there as well that you have to consider. So these are two different examples here, again, using a daily Google chart of the compression pattern and then the release of energy. And then again, I'll draw your attention to the idea of you have the duration. So this is 14 bars for the first one. And then you have a rating, if you will, of the tightness of the compression of storing the energy up. So this is 0.66. And so what this is saying is that the compression pattern lasting for 14 days here is essentially about 66% of what the normal price volatility has been leading up to that period. So we can clearly see that this is not a dead period. It's not a dormant period. We have a huge up move on the daily charts coming into this period, and then we trade for about 16 bars or so. And this is defined, when this is plotted on the chart, this is defined by a mathematical algorithm that's tracking this stalemate, if you will, between buyers and sellers. And then you finally get a situation where the buyers start to overtake the sellers and the prices really take off to the upside. And that's a payoff. That's what we're trying to take advantage of again. The second example here is where you see another storage of energy. This is a 16 bar, so about 2 bars longer than the first one. Still on a daily chart here for Google, and this is 0.75 ATR. So all of the average volatility here within the compression itself is about 75% of what we've seen in the market coming into that. So that's good. Typically, I like to see the compression patterns myself that are less than 1 to take advantage of. So in this particular case, again, this is a little bit strange because you get a sloppy price pattern. Google shoots up a little bit, and it comes back down a little bit, and then finally breaks out to the upside and releases the energy. So it doesn't always have to go right in our desired direction. It can give us a head fake and then reverse too. And those oftentimes can be very tradable patterns as well. I'll show you some examples on TradeStation here in just a minute. So the long straddle strategy is one strategy that you can actually look for to take advantage of a compression setup. And again, keep in mind the compression setup is not giving us a directional bias. So we don't know whether the market's going to head in the up direction or the down direction. So the long straddle is a neutral strategy. And what that involves doing is simultaneously buying at the money strikes, which will be the Delta 50 strikes for call option and the put option. So both the call option and the put option in this example are going to be buying the 40 strike price right here. Now, what I generally recommend as well is that you typically look at a less of a closer expiration date. So if you have, depending what you're looking at, let's say you're looking at a 240-minute chart and it's Tuesday of the week, you could be looking at Friday's expiration of the same week, or you could go 1 week out. But in general, you're not going out very far in terms of your timed expiration. So you generally do not want to go out, 3 months or something like that. You want the expiration date to be as close as possible, giving you the opportunity to benefit if the trade actually does what you expect it to do. And so the idea for the long straddle here, if we take a look at it, is as you see prices either head in the down direction with your put, that allows your put option to profit or head in the up direction, that allows your call option to profit. This is what your at expiration profitability curve will look like for the options, the straddle, long straddle option strategy. So the nice thing about this is your risk is limited. So in this particular case, it looks like we're buying a call option and a put option, so 2 options, and they both end up costing $400. And because we're option buyers, the most we can lose in this trade is $400, and that's going to make the assumption that the market goes nowhere. So we have a compression pattern, but it doesn't send an energy release in the up direction or the down direction. But if we get that energy release with this particular strategy, then we have the potential to actually profit in either direction. So that's the nice thing about it. It's a neutral strategy. As long as we get that energy release in the up direction or the down direction, that gives us the ability to profit potentially from this trade. And what typically happens is, for those of you who trade options, you'll know this, but is that options have what's called delta. So as the market moves in the direction, so the downside direction is the put. So as the market moves in the downside direction, your delta, and that's the amount of profit your option can generate per price move, per 1 point or $1 price move in the underlying market, that increases. And the losing call option here would actually decrease. So you start to see the market move in one direction to the other, the profitable side is going to start gaining delta. It's going to start growing from maybe like a delta 50, which means that for every dollar the stock profits, the option profits 50 cents, and that'll start getting in the money, and that'll go up to 60, 70, etc. And the losing option will start to go down. So that the rate at which the winning option wins increases, the rate at which the losing option loses decreases. So that's really how you're making your money. And then once you move far enough, and typically I'll say that you're not going to see this happen. You're not going to move so far as to recover your $400. You're not looking for that in this type of trade. You're looking to take advantage of the change in deltas here. So your winning option becomes more profitable, then your losing option loses. The rate at which that happens is favorable, if you will. Now, this is I'm not necessarily a big fan of the long straddle strategy in the case of the compression setup. So I'll tell you why. Because you're really looking at a situation where with the profitability graph, you're not seeing a lot of movement until the market actually moves beyond your strike prices. So instead of buying both options at the money strike price, and at the money means where the market's trading right now, you would actually buy your put option that's out of the money at 35, and then you'd buy your call option, which is also out of the money, at above the strike price. So you're buying your put option strike below the market, you're buying your call option strike above the market, and that's the definition of long straddle here. Again, this is an attractive alternative sometimes because it's cheaper. So the last long straddle was 400. Long strangle here, let me make sure I say it. The long strangle here, where you're buying out of the money put, out of the money call, is cheaper, but it takes a bigger move for this to become profitable. So I favor the long straddle versus the long strangle, but there's a little bit of give and take there. And it's the same, you're looking at the same impact as well. With the winning option is going to increase its delta faster than the losing option decreases its delta. The other thing I'd point out is you generally don't want to trade this strategy with a market with a really wide bid-ask spread for your options. So if you have a market that's not very liquid or doesn't have a very liquid options market, then you're generally wanting to stay away from that, because your slippage in terms of your entry price for buying and selling your options is going to eat you alive, and it probably will overshadow your potential profit for this type of trade. So just keep that in mind. So markets like the SPY, DIA, QQQ, and very liquid stocks, maybe like Apple and Google and Amazon, things like that. Those could be markets you could consider, but you always want to work your trades. You want to, when you enter your options and you're buying your put, you're buying your call, if you have a wide bid-ask spread, always work your trades. Even if you don't see the market there, there's usually a market that's out there that'll pay better or sell better at better prices than what's displayed on your option block, your chain. So you can always typically do better if you have a wide bid-ask spread on option markets. But in general, if it's too wide, I just say pass on it. Don't use options to trade it, essentially. You just want to focus on trading the underlying market as well. All right. So let's take a look at some examples here. This is a NASDAQ 120-minute chart right here. You can see that the first compression setup here is 7 bars, a really nice compression. This is actually a 0.51 ATR, so that's essentially showing us a period of time where there's a stalemate between the buyers and sellers, and the volatility's dropped down to half. So it's not dropping down necessarily because the market, or in this particular case, is slower, but it can be slower. So you've got to watch that. So the reason why I wanted to talk briefly about this is that the Asian session sometimes can be a very slow session for the 24-hour futures market. So make sure that you're just not seeing a compression necessarily because you're just in the night hours where Asian market's slow. Now, having said that, sometimes when you get a really nice compression pattern like this and the trade breakout happens right at the opening of the day for the stock market, those can actually be really nice setups. So the opening activity of the market, if it comes out of a compression pattern, it might be worth watching, even though it's a 24-hour futures market, and it does end up being a little bit slower during the Asian market hours. The other one here, the second example here on my chart on the right-hand side, this is a longer compression, 17 bars, and this is actually stretching really over an entire 24-hour period, essentially. And then we finally get our breakout, to the upside, and that's really what you're looking for. So you'll also see here there's a magenta compression plot, and that's a power compression or an extreme compression. So that only plots when the prices are really closing in on each other, and sometimes if you get both of them together, then it can make or state a case for a higher quality trade setup. So you have both to watch for, and you have some flexibility here. I'll show you on the real chart in just a minute in TradeStation, where you can actually play around with the settings and then be more particular about the type of compression you're looking for. But again, with both of these examples, you see really nice breakouts, really nice energy release in both the first NASDAQ example and the second one as well. So you can keep an eye on these types of patterns that evolve even for 24-hour markets like the futures. Now, trading compression breakouts. How can you trade these? We know, from the theory of compression patterns, that energy is being stored up. We want to make sure, again, it's not just a dead period in the market, but it's a stalemate between buyers and sellers, and then we're looking for that energy release. So that's the theory behind it. We don't know, again, the direction of the energy release. So how in the world can we trade this? I've shown you some neutral option strategies that you can consider. The other thing you can use is a breakout strategy is one very simple alternative. So when trading the energy release, you can use a drill down breakout strategy. So what does that mean? Now, drill down means that you're looking for a shorter term time period. So if your setup occurs in, like, let's say a 240-minute chart, that's your setup, okay? Your trading time frame, then you may want to consider like a 15-minute chart, or 15-minute price bars versus 240. And this is a good time frame to look at because you get more data points in the trade, and that allows the trading strategy to oftentimes get in quicker, get in faster, and capture more profits when it comes to the realizing more profits from the predicted or the projected price move, either in the up or down direction. So the drill down's part of it, choosing a shorter term bar interval time frame for your actual trading, if you will, trading of the setup. And then the breakout strategy is a type of strategy. Here, I'll show you the Donchian channels we can look at here. So this is a chart of Google. It's a 120-minute chart. We have a really nice breakout here, or run up into the setup. And the setup here is plotted on 6 bars, very nicely positioned here, I would say, in terms of the general volatility we're seeing in the market. And then we get that really nice continuation here. So this is textbook. It doesn't always happen like this, but when it does, it's very nice. And so the question is, okay, how do I trade that? What are some very easy ways that I can use a trading strategy to trade it? And one answer would be you can use a breakout strategy. So for those of you not familiar with how this works, it's very, very easy, very simple to use. And what you're looking for essentially is when your prices cross above the blue line here, this is your a reference look back to your highest high for a certain period of time, or if they cross below the red line, those represent your buy and sell signals. So in this particular case, you could have as you get into the compression pattern, you could have a false signal or two. You can see that we bought first time right here, and then we end up selling very shortly thereafter, and then we have a buy signal after that. So when we finally break above the blue line on this, right above the green arrow here, this is our trade entry when it breaks above the blue line. Now, when you're trading channels, I always recommend forcing the market to actually break through the channel. So don't put your buy stop, which would be your entry stop, right at the level of the blue line. You want it 1 tick or 1 cent above that, depending on the market you're trading. So you want the market to actually go beyond the blue line to get you into your long position, and then your red line now represents your exit. So that's where you put your exit to stop, and as the market goes our direction here, let's say in the upside direction we bought, the red line now is your reference point to put your stop loss right below that line. So when prices finally drop below the red line, that's when you're out. So you get in when you buy, when the markets trade above or break out above the blue line for the buy side, and then you end up exiting when they get out or when they break down below the red line. Very, very simple. And by the way, stop orders are not just for exiting. It's not just for risk management. You can actually use stop orders as well to enter positions in a market. And there's actually some pretty cool stop trades where you can put a stop, a risk management stop contingent upon an entry. So you can actually instruct your trading platform to say, okay, I'm flat right now, I don't have a position, but if my buy stop gets triggered, then I automatically open up a new risk management stop when that happens. So as soon as you get in the market, you automatically have an additional stop that covers your risk, that defines your risk. So there are some really cool different types of orders you can use when trading the markets, but very, very simple. Your buy stop gets you in, and then your sell stop, you're changing that. You're trailing your sell stop all the way up here, and then finally you're getting out. And this is happening over a relatively short period of time because this is actually a 15-minute chart, our drill down chart, taking full advantage of the setup we saw in a longer term chart in Google. Can you trade other markets? Does the theory work on markets like soybeans and commodities? Yes, it does. It can. So here's an example of a compression pattern. Now, this is a little bit of a cautionary example because this happens over the slow night session. Beans are not always going to be slow during the night, but they can be. The thing I like about this is that the breakout is occurring right as we enter the U.S. trading hours, and oftentimes those can be really nice trades. So we have our 5-bar compression. The thing I like about the compression as well is that we have a 0.41 ATR. Now, part of that is going to be due to the fact that the night session is just slow oftentimes, for the 24-hour futures market. So just recognize that. But it's very well defined. You have a very nice stalemate between buyers and sellers. And then we get our final breakout here. And in this case, we're getting a breakout that goes to the downside. So we're going to be shorting the futures, very easy to do, and then profiting from a fall in prices there. So this is what this looks like using the same breakout strategy, except for in this case, what we want to do is we want to sell soybeans, go short soybeans when prices break down below the red line, and then our buy stop, which is our exit stop, is positioned above the blue line. We simply trail that all the way down until prices break out above the blue line. Now remember what I said before, you want to make sure your stop is above the blue line, not just right at the blue line. Here's a case right here where prices touch the blue line but don't go through it. So if you had your stop right at the blue line, you would have been stopped out and would have left some money on the table. So this is a shorting example for those of you not familiar with shorting a market and profiting. I recommend you look at learning how to do that, because as a trader, a lot of the times the profitable price moves, as they have been really throughout the month of October, they've been to the downside. So if you can think of an analogy in your mind of being a fisherman, and if you don't short a market or don't know how to profit from falling prices, then you're fishing half the lake. So if you're a fisherman, you say, I'm only going to fish in half the lake. It doesn't make sense. You're losing potential opportunities out there to make money. And so selling a short a market and profiting from falling prices is a great way to make money in markets as well. So just keep that in the back of your mind. And by the way, as a hedge fund manager for 20 years or so, I can tell you that many of our best years were from shorting. It wasn't from going long markets. Many of the biggest opportunities we had to make money in the markets came from falling prices. So keep that in the back of your mind as well. So here's another example here. This is NASDAQ. You have a nice compression pattern early on here. Again, be a little careful in the night session. This is the first one on the far left-hand side of my screen is a 0.51 ATR. Very nice compression pattern. We can then turn our attention to the breakout strategy and use that to manage our trades. This is a case where you have your compression pattern. You buy on the breakout above the blue line. It happens to break out. We don't know what direction, again, it's going to go. But we have a buy signal here, and then we're trailing our risk stop, below the red line here and following it all the way up. Now, in theory, here's what you're looking for. You're really looking for this initial price move, the surge, the energy release, and then you're out. Okay, meaning that you're no longer taking new signals. But in this particular case, you can see that the market actually extends beyond that, the energy release. It's now continuing an up move. And if you have not been stopped out and you're following a rule-based strategy like simple breakout strategy here, stay with it. I mean, it's just as long as it continues to go your direction. The first part may have been an energy release, right? But it's going your direction and the market's giving you profits and increasing your profits. So stay with the trade and take everything the market has to offer when it comes to that. But keep that in the back of your mind. And I'll show you on a real chart here in just a second an example of how you can tell when your energy release is done. All right, so compression setups can represent excellent trading opportunities. Let me go ahead and pull my TradeStation chart up here quickly. So let me pull that up. Give me a second here. Okay, so let's go ahead and look at, this will be an example of Apple 240. So Apple, for whatever strange reason, Apple 240-minute charts are really nice for giving us the ability to, to trade on some of these compression patterns. So if you look on my chart, let me go ahead and just expand it briefly here. You can look at a couple of compression patterns that have happened in recent weeks, really. So you have a really nice one in June, and then this is the one I'll circle here on my chart. Right here, that's a nice one you see in June. This early one here that sold off, and then you have a one that really kind of went nowhere in July, and then you have a couple of nice ones that unfolded in August. So let's just go ahead and pull up the next chart, and I'll show you how you can drill down to trade these using the breakout strategy. But one thing I wanted to point out here is that one way to determine when the party's over is looking at a simple momentum strategy like MACD, and you can use that on the time frame of the setup. So in this particular case, we'll use, let me go ahead and clear my ink here. Let's use the third compression setup right here. So you have a really big surge right here, and then we go right into 16-bar compression, and then you have your energy release to the upside here right after that. So that's what we're trying to take advantage of again. If you watch your histogram here on your MACD, you'll notice that once it starts to fall, you're probably done with the opportunity. So I'll go ahead and put a line where that happens. So you'll see that we had the energy release, and then once my histogram on my MACD indicator starts to come back or reverse itself, that's going to represent the finish of this opportunity. Let me make my lines a little bit wider so you guys can see it. So this is the first one, and then this will be an example of the MACD histogram kind of falling back and reversing for the second setup as well. So we have two nice compression setups. Once we have the energy release and the market slows itself, then you can start looking at, you're done trading the opportunity. In other words, you don't want to continue to take new trades once the energy release has happened, because that was your edge. That was the move that you were looking to take advantage of, and anything that happens after that is not related to your original setup. So just keep that in the back of your mind. So again, that using the MACD to determine when the party's over, and that move is a good indicator. And then you can use the simple breakout strategy to manage your trades. So here's the first. Let me go back to the setups here. So the first setup here, I'll circle this in my chart, is this one over here on the left-hand side that happens in early June, a 7-bar setup, and it has a 0.56 ATR, which says that the compression was almost half of what the market was normally trading with this particular case. So in this case, I'm going to go ahead and show you an example of how you could have traded that just using a simple breakout strategy. So the blue block here on my screen is essentially the Once prices sell below the red line, we're using that as our sell signal, and then we can simply trail down our buy stop exit with, as prices kind of move down here. So, and I'm using, for the breakout strategy here, the breakout lines, I'm using a symmetrical 25 bar, setting here. And that's not a bad one to consider. The other thing to keep in mind is that we were looking at our setups on a 240-minute chart. I've drilled down here to a 15-minute chart to actually manage my trade and take my signals. So it's a shorter term time frame, but in my experience, it allows you to get in and be more reactive, get in a little quicker, which reduces your risk, and then also allows you to potentially capture more of the profits here as the stock or the market sells off. All right, so let's go ahead. I'm going to actually scroll over the right here. Let's take a look at the other two compressions here. This happened in August. So the first one here, go back to my chart on the previous page. So I'm going to circle this other one. This is the 16-bar compression that happened in early August, 0.94 ATR. And that is essentially obviously a nice compression coming in right after a fairly strong rally. So this is on, again, a 240-minute chart. That's the time frame of my setup. And now I want to drill down to a shorter term chart here. And this is where the blue box comes in right here. And then when I get my breakout, I want to trade it. Now here, this is an example of maybe a whipsaw or two with inside the compression pattern itself. So if the compression pattern lasts for longer than you think, you've got to be careful about that, because that could lead to a situation where you might get whipsaw trades inside of the pattern before it actually breaks out and releases energy. But it finally has a buy pattern, a signal here, I should say, and then prices move up fairly quickly, and then they finally come back down below the red bottom line, red bottom channel, and then that's your exit. And once this has happened, if you catch this trade and you're able to make money off of it, then you're done. So that's all from this specific compression pattern setup right here. Once the releases happen, then you're essentially done trading that. And then the next one also, it has another really nice compression pattern here that lasts for a period of time. And it does actually a fairly good job of avoiding the whipsaws here. And that's why I like the 25 period on the 15-minute chart here, trading a 240-minute setup, because that we finally get our buy signal here when prices break above the blue line, and then we're simply trailing our stop below the red line here. It does a pretty good job of keeping us in, and then finally gets out and captures a fairly decent amount of profit here, maybe about $10 per share. And then again, once that's happened, once you capture that big surge, you're done. You're not putting on new trades as time goes on. So that's all for that. You realize the potential of the energy release, and that is where essentially what you're looking for. And once it's happened, you don't want to overstay your welcome, because at that point, if you do that, you're no longer trading with an advantage there. You're trading based on something different outside of the setup there. All right, so compression setups can represent excellent trading opportunities. The top linear compression pro indicator that you saw on the chart is designed really to be one of the most powerful compression indicators out there. Let me show you why. Let me just pop this up here and just show you some cool aspects of this indicator itself. So I'm going to go ahead and open up my format indicator dialog box here. Give me a second. So this is the, let's see here, Linear Compression Pro. Let's format that. And this is really cool because it allows you to do a number of things. Now, it actually has, for the first parameter here, this is compression type. It's a COMP type, and you can actually type in 1, 2, or 3. There's actually 3 different mathematical formulas there that define compression. So if I change this to 3, for example, then this is going to be the strictest definition of compression on my chart. So I'm going to press OK right here, and then you'll notice that some of the compression patterns that we saw previously are gone. So this is now looking for just very specific type of compressions that are much more demanding, if you will, from a mathematical standpoint. So you'll see, even going back for quite a ways, all the compression patterns that we saw there, a lot of them are gone. That's not to say that this is always going to be better. It's just a stricter definition of the compression pattern. So the number 3 is, and then you also have a number 2 definition as well, and I'll change that. It's a slightly different mathematical definition of compression. I'll put 2 in there, and then you'll see that a couple of the patterns that we tracked start coming back, and even more so. We get even a few more compression patterns as well. So this is really a kind of a trial and error thing in terms of what you want to look at when you're looking for these different types of compression patterns. But you might find that you like one of the mathematical definitions more than the others in terms of how it actually identifies compression. And then again, what's interesting here is that you also have, for this last compression pattern, you have 2 compressions. So you have your normal compression represented by the cyan lines, and then you have an extreme compression here. And so you can choose just to track extreme compressions. And that's a much stricter, much more compressed period, if you will, than the normal one. So if I wanted to, I could go say I'm down here, and I could, let's see, middle length. Okay, you can change, by the way, the colors of your, the lines as well. So I've got my compression normal color as cyan, extreme compression color is magenta, and then you've got the center line as well, defined as yellow in my example. One more thing I was going to show you real quick is, this is a little hard to see, so I'm going to zoom in. But you actually have a yellow line that's forecasting a potential direction of a compression. So that's kind of a cool feature as well. So my yellow line, it goes down for this first one. This first one kind of fizzles out. It really almost goes right into the second compression. That's actually slanted up. So that's telling you that there's a bias there for the direction of the potential energy breakout. So both of these had up slants, which is saying that there's a likelihood, or there's a possibility that when the energy does finally release, that you get that release in the upside direction, which is kind of a cool feature. So there's a lot of flexibility here. The one last thing I would tell you is that a cool aspect is you can actually define, how long you want a compression to last before it even plots. So you can put down here min compression bars. That's my third parameter. I've got it as 5. If I put that as 10 right here, then all of a sudden several of my compressions are going to disappear from my chart. Because if there's not 10 bars, then it's not going to compress. So right here, it barely makes the cutoff. But my other compressions before that don't make it. So if I tell TradeStation or TOS or whatever your platform you use, NinjaTrader, if I tell it that don't even bother me for a normal compression unless it's at least 10 bars long, then it's only going to plot those type of compressions, on your chart going over time. So if I go back in time here, it's only going to show me compression patterns that are at minimum 10 bars or more on my chart. All right, so let me go ahead and tell you, I've got a couple of people asking, let's see, how do you, or is this available on different platforms? Let me go ahead and answer that. So the top linear compression indicator, again, is designed to be one of the most powerful compression indicators out there in the market. You have tremendous flexibility. So you have simple settings, simple advanced settings to customize your market, okay? So this is, again, much more powerful than most of the ones I've ever seen out there, and it gives you tremendous flexibility. What markets does the compression pattern work on? It works on stocks, it works on options, it works on futures, and it works on forex. And give me just a second here. I know there's questions out there. I'll work to address the questions here in just a minute. So you can trade this really on all markets and all time frames. The principle's the same. You're looking for volatile periods that all of a sudden start compressing, storing up energy, and then look to release that. But in theory, it's designed to work on all markets out there. Now, what's really cool and powerful about the indicator too is that it gives you the duration, and it also gives you the actual compression range, if you will, and it defines that an average true range. So you get this valuable information is plotted above and below every compression on your chart, and so you can make a determination if the compression is tight enough, if it meets your requirements. But this is just designed to give you more powerful analysis versus what you might otherwise see in a lot of other compression indicators. Now, the other cool thing is that the indicator actually includes 3 customized settings. So there's actually 3 different definitions. You can define using number 1 under comp type, closing value only. You can use median price value. That might actually be the most liberal of the definitions. So this will find more compressions, number 2, than any other of the definitions here. And then number 3 actually uses a scatter outlier analysis definition, which means that it's the strictest. that means your compression really has to be a tight compression for it even to show up on the chart. So depending on what you like, depending on what you want to see, how picky you want to be, you have 3 different options here for the mathematical definition of what a compression is, which is really cool. What platforms does this is this designed for? So we've actually developed this across a number of platforms, including TradeStation, Thinkorswim, TD Ameritrade, NinjaTrader 7 and NinjaTrader 8, eSignal, and Infinity IAT. So you want to go to, and here I'll just get to this in a second. You want to make sure you go to www.toptradetools.com/go to see the special off here. I'm just about to show it to you. So I'm going to go ahead and just type in the link here and send it to all of you, and then let me get to my final slide, or I've got 2 more slides here. So it's normally an indicator that is $500, but we're knocking off $200 today, and so you save, and it's available for only $297. So this is an indicator again that's been designed across all those platforms. If you have any questions, we're available to answer those. It looks like the screen cuts off a little bit on your chart, but it's 859-963-3445. I'll type in the telephone number as well. So it's 859-963. If you have any questions at all about this, 3445. I'm copying that and sending this to everybody through the question box. But again, this includes the 3 customization settings. You've got compression sensitivity, minimum duration settings as well, extreme compressions, which is an extra add-on for finding those really tight compressions as well, the magenta color I had. And then you have customizable color settings. Now, one thing I'm throwing in here that's pretty cool is you also get instant access to our compression profit strategies workshop. So this is designed to talk more about this type of setup. So strategy, compression, trading stocks, options, futures, and forex, selecting timeframes for compression setups, breakout trading strategy review, how to compression trade entries and exits, learn to identify the end of these setups when the party's over, and how to trade options with the top linear compression, touching on some of the points we've already made with neutral option strategies, and then how to select strike prices, how to select expiration dates, and then learning the latest compression trading strategies. So it's a workshop that's actually on demand right now. Again, if you go to www.toptradetools.com/go, you get the discounted price. You also get the indicator, the top linear compression indicator, and as a third add-on bonus, this is something really cool, you also get, I'll go back here, you also get the breakout channels. So if you don't have the breakout channel here to trade compressions, this has actually been developed across all platforms as well. So you get the blue line and the red line here to trade on a drill down time frame and execute on the strategy that we're talking about. So it's really 3 things thrown in here, and that is the Top Linear Compression Pro indicator, and then the on-demand workshop you get. It's available right now. And then last but not least, you get the breakout lines as well for across all platforms. Now this includes a multi-license ability as well. So if you have TradeStation and you have NinjaTrader or TOS, you can actually download more than 1 copy of the Top Linear Compression Pro. So that is the promotion we're putting out there. Let me go ahead and put up my, give me a second here. I'll put up the chart here and see if you guys have any questions and see if I can just get you some answers here. So let me go back to the compression setup page right here. Okay, what is your market outlook? Okay, a little warmer. Okay, see here. Okay. All right, so so let's see, for crude oil, let me throw that up there. You can use a continuous chart, by the way, if you want to define that. And what time frames tend to work? And let me go ahead and just make sure I've got the right settings here. So I'm going to pull up my format. I'm going to put it on 2. Okay, it stays on 2. And then minimum compression bars, I'm going to move to 5. That's what I typically like to have in my charts. So for crude oil, you can use all time frames. Now this, if you have enough volatility, you can even use 30 minutes as well. And you can find some nice patterns as well. So even with today, coming out of last night's session into the election, we have really 2 pretty good compression patterns here. So the first one, crude oil, 30-minute chart, it went up at first and then reversed. Now sometimes, even with this type of price action, you can get a very nice trading opportunity. So you see the rally and then the immediate sell-off there, and you still get the energy release that you're looking for. And then the one that just happened really with the breakout this morning was a really nice compression pattern lasting for 18 bars, and then we get that surge higher. We get the really nice breakout higher, and then, yeah, so both of these resulted in fairly decent moves. The first one gave us a little bit of a head fake there, and these, again, still are very tradable patterns. You can just spend the time, look at it, you know, and see how those work, and those oftentimes can be pretty good trading opportunities as well. Yeah, so Martin, I don't know. You can ask Jeanette if this has been recorded, but I think it might be. I think today's session might be recorded. All right, so this is it in a nutshell. Let's take a look at SPY real quick for those of you stock traders. And so yeah, so we get a gap up here. Now, this is a case where we have a nice compression pattern. Now, obviously, heading into the you know, the situation where we have the election. I'm sorry, all the different House and Congress and Senate seats were voted on yesterday. So not surprising that we have a gap up. And if you have this type of thing where you have, you know, we started to see a breakout yesterday, so you might have been able to catch it before it gapped up today. But when markets are only trading for U.S. hours, sometimes you may miss out on those. So just be aware of that might be a situation where you just might miss out on a trade. So the 24-hour market, so if I put up ES here, that gives us more of an opportunity to catch those because they're actually trading, you know, they're trading fluidly across all time zones throughout the week. So those are easier to trade, the types of setups with the compression where markets are actually, trading 24 hours a day. All right, so that is the top linear compression, giving you some ideas on a different type of, different type of setup here for those of you not accustomed to that. Again, the special offer for Jeanette's event here today at a Trade Thirsty event is the $200 off normal price. Again, if you're interested, make sure you do not go to the website. Don't go to toptradetools.com. Go to toptradetools.com/go, because that's where you get your savings. And again, you get the linear compression indicator, you get the extra bonus channel breakout indicator as well, and you have instant access to the workshop that covers all these topics I just went over. So that's all included, and this is a limited time offer. Normally, if you just go to the website, the indicator is $497, which does not include the workshop, and it does not include the Donchian breakout channel indicator. All right, so thanks for coming. This was, appreciate your time this morning. Fun to present the compression setup. And Jeanette, when you're ready, I'll let you take the reins here.